Hello sector watchers, welcome to the show. This is the 80th episode of Sector Spotlight for Tuesday the 18th of May, recording it on Monday the 17th. My name is Julius de Kempenaer and I'm hosting the show today as usual and present to you from Amsterdam in the Netherlands. You will see my handles on the screen, and if you want to share anything with me, have any questions or comments, please use any of those channels, drop me an email, or simply use the channel that you prefer most and I'll answer in that same channel. For today we will be looking at last week's rotations. Obviously we'll be trying to put all of that into a longer term perspective using the weekly RRGs and the weekly charts, and I'll be answering at least one question from the mailbag. So on the asset class front we have the daily RRG on the left and the weekly one on the right. We'll quickly see what happened in last week. I've sorted the table on its performance. A lot of red, only one plus, that was for the dollar index. The benchmark down 1.1%, and usually that means that the stock market is down, and that's also the case here. Stocks down 1.4% versus a benchmark of minus 1.1%, and the government bond section was down 40 basis points. If you look at the rotations, then you can see here, especially the last day, that it hooked down a little bit, but it was clearly a positive week for government bonds, and the opposite was true for stocks. But here you saw that last Friday we have a little bit of a hiccup. I'm sure we're going to see more about that when we talk about the sectors after this. Commodities been doing really well in the last few weeks, but not so much last week. GSG losing 1.6% and DJP losing 2.3%. But in the bigger picture, that is sort of a correction, digesting of the recent gains. When we put this into perspective versus the weekly stuff, let me select the government bonds here and do the same here, because here are the weekly rotations. It's a little bit of a longer term picture. This is the 1 week thing, so we're now going to try to put that 1 week rotation into the longer term picture on the weekly chart. And what we see here is that government bonds had a good run, and then in terms, we need to zoom in a little bit here because you see that we're moving down. So this is April 19, 26, and then this is the last 2 weeks. So the week before last week we already saw that hook down, and then you can see that there is almost no change in the weekly position based on this daily rotation here. But the longer term picture, government bonds are still on the left hand side, which means weaker than the stuff on the right hand side, and very clearly the stock market, stocks, ITOT, is still on the right hand side. Very short tail, still a stable trend. If we put that into perspective, you see stocks coming down here. That's sort of, let me blow that up a little bit for you. We can see what happened there over the last few weeks. We see a nice hook back up. So this is April 19. I'm looking at the date above the table here, and I'm using my arrow keys to actually browse through history. We're picking up those a little bit longer term trends here in terms of relative strength, and then here you see it hooking up, and this is last week. So the last week is almost no change for stocks, and like we saw for government bonds. And here you see the daily rotation that's causing that little hiccup here. Is obviously a little bit of a delay in the weekly RRG. So for the long term picture, stocks still to be preferred over bonds. That did not change. If you look at the biggest changes for commodities, so GSG and DJP, which are inside the leading quadrant but rolling over on the daily, if we bring those up on the weekly RRG, then we see that they have dropped pretty rapidly into the weakening quadrant. But in terms of relative strength, in terms of values on the RS ratio axis, both are still the strongest together with real estate asset classes. And there is a very good chance that these tails on the weekly as well as on the daily will make a rotation from leading through weakening and back up into leading. We'll be talking about the monthly charts at the start of next month again, but we've seen those monthly charts at the start of May this month, and what we concluded was that there is a very long-term turnaround in the making. I think we've seen the first leg of that, and we're now just digesting that first big move up. So I'm monitoring those tails here, because when they start to turn back up, first it will happen in the dailies and then it will be followed on the weeklies. That could be a very good entry or re-entry moment for commodities. So let me change this RRG to weekly and then bring up some charts that go with the RRG here, and let's just take the most important one. So here is ITOT on the price chart, and I'll highlight the tail for you. And as you can see, that short tail is caused by the almost flat movement in both RRG lines. That's usually causing these short tails. Still on the positive side, that trend is still higher. And what we saw here is that last week the price actually touched the lower boundary of this trend channel that still is intact. When we dive into the S&P a little bit later on, you'll see that there is still a little bit of toppish formation, topping pattern going on. So I am wondering whether this is the correction that we've been waiting for. I hope so, but I don't think so. So I'm afraid that we will have to see a little bit more downside for the stock market. So that's both for ITOT and the S&P 500, which we will see later. Quickly move to government bonds. We saw that tail on the right hand side. There's an interesting pattern developing on the government bond chart, and that's this one here. This looks like a small bearish flag in the making. We have this pretty severe decline that panned out since July last year, taking GOVT from 28.25 to 26.25. Let's round it off. Two big figures. That's a big number in the bond market for this ETF. And you can see that after this decline, we now see a little bit of a recovery, and that seems to be taking shape in the form of this is called a bearish flag, and the execution signal will be when we close below that slightly upsloping support line of that small pattern. And that's not a good sign usually. When that happens, you can expect a rapid further decline in GOVT, which means a rapid further rise of yields. And bringing that all together, that would not be very good for the stock market. So I am still pretty cautious for stocks as a whole. And let's now start to take a look at sector rotation, proper sector rotation. On the left-hand side, the RRG for US sectors. Left-hand side on the daily scale, and the right-hand side on the weekly scale. Let's kick off with the daily. It's already after the close on Monday, so we're going to just bring this chart to last Friday. So we see last week's rotations. And if we sort it on percentage change, then benchmark S&P down 1.3%, and only 3 sectors are or have been underperforming last week. But they're big sectors. They're discretionary, technology, communication services. These are serious sectors that underperformed the benchmark significantly last week. And obviously that means, because it's a zero-sum game here in sectors, this is a closed universe, that we need a lot of smaller stuff on the upside to actually compensate for that underperformance. Pretty much the sort of defensive stuff, staples, financials maybe not so much, materials, utilities definitely, energy outperforming, healthcare outperforming, industrials, and then we have real estate, sorry about that, down 1%, only 1%, benchmark down 1.3%, communication services 1.5%, and then the big damage was done in technology and discretionary. If we look at the tails, then we can see that discretionary is rapidly moving into the lagging quadrant. Technology, similarly, last 2 days picking up a little bit. So this is not picking up. It is basically less bad. That's how you should read it, the pickup of momentum. We're still in the lagging quadrant, so it's still going down and momentum is still negative, but it's not as negative as it used to be. So if you want to see it from a positive point of view, then that's how you should see it. Communication services rotating into lagging now, and we have industrials inside leading, healthcare doing a really good job on the daily RRG, energy moving forward, just minding his own business, doing right, not a lot of momentum, but steady on the relative strength scale, on the RS ratio scale. Utilities picking up there, materials doing nicely inside the leading quadrant, financials losing a little bit of momentum, but still okay, and staples pushing into leading, and on Friday losing a little bit of momentum there. Now, if we bring that to the weekly RRG, then let me put that here, and let's just bring in today's price action, just because we can. Bring that one right here, and let's go over these tails one by one in alphabetical order. So when I do that, I just basically align both tables, just sorting it on symbol, so I can highlight the left and the right and look at the interaction between those tails. So starting with materials, and you can see that the longer term picture here, materials still pushing further into the leading quadrant. That is good. That is a strong move, a strong tail, a good heading. And that's pretty much confirmed by what's happened on the daily scale last week. So materials remains one of our better sectors, one of our good picks. We go to communication services. We saw the tail rotating into the lagging quadrant on the daily RRG, and that's pretty much now basically coming back in line with what you see on the weekly RRG. So on the weekly, communication services is moving from leading into weakening. That happened 3 weeks ago. 3 weeks ago, we started moving into the weakening quadrant. And that negative momentum is now picking up again with the daily moving into the lagging quadrant. So both tails are now confirming each other, which is a negative for communication services actually. We look at energy, and we have that big rotation for energy that's been playing out on the weekly. We're digesting that big move higher over the last months, I should say. And we see on the daily that it is still feeding that trend nicely with strong relative strength ratio. It's losing a little bit of momentum, but both tails are the highest on the RS ratio scale, and that's the most important one. So both on the weekly and on the daily, energy is the highest reading on the RS ratio scale, which makes it a very strong sector. And the way I read this, there is a pretty good chance that both the daily and the weekly tails will go through a rotation, leading, weakening, back into leading. So that remains a strong sector. If we go to financials, then we see the leading to weakening rotation on the weekly, but as I said, it's the second strongest reading on the RS ratio scale. It's got plenty of room to rotate back up, so financials remains a solid sector. It's not at a positive RRG heading on the weekly chart, but it's got plenty of relative strength to actually keep up where it is and potentially rotate back up. We're losing a little bit of momentum on the daily scale, but we're still moving higher on the RS ratio scale, and that's a good thing. Industrials steady on the daily, and if you look on the weekly, we rotated downward. That makes it a slightly not so good sector. I'm not going to say it's a bad sector, but there are better ones around, and it looks as if industrials needs a little bit of time to digest its recent gains. It's still stable. It's a short tail, so there's not a lot of power behind this move. Similarly, it's still moving higher on the RS ratio scale on the daily. So we'll have to see how that rotation pans out. Not super strong, but definitely not really bad. Technology is a different story. That's been doing the damage over the last few weeks. It's still inside the weekly quadrant on the. It's still inside the lagging quadrant on the weekly RRG. It's a short tail. That means that there's not a lot of power, but it's stable. So it means it's a stable relative downtrend inside the lagging quadrant, and it's confirmed by the daily tail, which is also inside the lagging quadrant. And if you look at the daily, it's actually the weakest reading on the RS ratio scale. So we see a little bit of a hiccup. I'm not super convinced that this is the end for the weakness of technology. We'll be looking at the chart later on. If we go to staples, had a pretty good week last week. It's actually doing pretty good on the weekly, inside the improving quadrant and nicely heading towards leading. We see that supported by a strong move on the daily RRG, losing a little bit of momentum over the last few days. We'll have to see whether that rotation can actually continue into the leading quadrant. But it's definitely one of the better sectors at the moment, not surprisingly, because it is one of the more defensive sectors. If you look at real estate, doing really well on the weekly. We mentioned that a few weeks ago already. It's now stable. It lost it. You see that the last observation here is downwards, and that's corresponding with the rotation through the weakening quadrant. It's almost invisible because it's so yellow, but it's a very short tail, and this is also a very short tail. So it's the way I read this is it's a stable relative uptrend that is slowing down right now, but it's still there. So not too many problems for the real estate sector. Go to utilities, then strong move, strong heading inside the improving quadrant on the weekly RRG. If you look at the daily, then it's hooking down right now. So we have, this is Friday, so Thursday to Friday we go down, and then today we lose a little bit of momentum. It's in line with the market. This is very close to the benchmark. On the weekly tail, it looks a little bit better, and it looks as if we're on the way to a move towards the leading quadrant. Again, a little bit more defensive sector. Go to healthcare, pushing into the leading quadrant on the daily, and we see a similar move on the weekly RRG, where XLV is inside improving and pushing higher, and that is just confirmed by the daily tail. So I expect healthcare to continue its good streak for the time being. And then we're going to finish off with consumer discretionary, which on the daily is almost a straight line into the lagging quadrant. And if we put that next to the one on the weekly, then you see that there is it's a momentum rally. That's very clear. We gained momentum over the last, this is a 5-week tail, so over the last 5 weeks. But if you look at, this is only today, but you see that it is almost not there, and it's just losing that. So we're going to look at that chart later on, because I think it's an interesting chart. But this one is telling the story. This one is now pushing into the lagging quadrant, and I think I would not be surprised if XLY on the weekly wouldn't even reach the improving quadrant, but just hook down further into the lagging quadrant. Well, we're gonna go for a break of 30 seconds, and during that break I'm gonna prepare my screen and my setup to watch some charts of sectors compared to the weekly RRGs. As promised, I have now loaded up the weekly RRG for sectors on the left, and we're going to use the right side of the screen to watch some charts. Before we start with the sectors, I promised you to have a closer look at the S&P or SPY, and I brought up the chart that we've been updating here in Sector Spotlight for a couple of weeks, just to see how last week's decline is fitting into the narrative that we've been presenting here. Obviously, that negative divergence that I talked about last week worked out rather well. We saw that sharp decline and the recovery. Let me get this right. So this is 12/13. So this is Friday, and this is Monday. So this is yesterday's price action. So Friday you saw a little bit of a recovery. So the first few days, so this is Monday, Tuesday, Wednesday, Thursday, and then Friday we got the hiccup. And it is exactly closing that gap that we made there from Monday to Tuesday. Looking at this chart and the fact that we pushed below that 410, below that 410 level, I think is important. That negative divergence is still, it caused the initial decline. We've seen that, so we've seen the initial decline. So the big question that we now need to answer is, was this the decline that we've all been waiting for, that we've been anticipating? Looking at this chart, it really wasn't that much of a decline, was it? It was vicious, it was fast, it was maybe a little bit unexpected, but in the bigger scheme of things, it's not a really big decline. As a matter of fact, didn't even reach the lower boundary of that trend channel. So I think that what we've seen Friday and today is a recovery price action. And the ease of movement and the risk is to the downside, while the upside is now limited. There is a gap resistance, and there is even the 423 level, which is now the high, which is definitely going to come back as a resistance level. So for the market as a whole, I am still pretty cautious. Long term, no problem. Short term, I do think that we do need to go 400, maybe a little bit lower, to actually digest all that rally that we've seen, and maybe even further. We will only be able to tell in coming weeks going forward. But for the time being, I remain pretty cautious for the S&P as a whole. So which sectors do we need to keep an eye on? Obviously technology. It's the biggest sector. It's a very important sector. If I bring up my technology chart that I've been maintaining and updating here, then you see that it has reached the lower boundary of its channel, and I've purposely not updated the chart. So these are lines that are in the chart for quite some time already. You see that we touched the lower boundary, makes it even more reliable. We're bouncing off it right now. This is only Monday's price action. I do think that we will see some resistance in tech if we even get there, just below 140. But what I'm watching is that rollover, that decline in relative strength. It has now started a series of lower highs and lower lows. The RRG lines are both below 100. You see that relative momentum is leveling off a little bit, but relative strength ratio is still pushing lower. If that momentum picks up to the downside again, we will see further weakness in technology, and we will see technology pushing further into the lagging quadrant. So technology remains the troubled child for the time being. The other big sector that I want to discuss with you is consumer discretionary, because let me get that on the RRG. You see it rallied in momentum terms. It was a momentum based rally, but we're still on the left hand side, and as you can see that today's price action is moving it lower on the RS ratio scale. But I hope that you agree with me when I bring up that discretionary chart that doesn't look too good. It's touching the lower boundary of the channel. We had that big move, that big week down last week, and that little hiccup here, that's today's price action, or when you're watching this, yesterday's price action, so Monday the 17th. But what I really don't like, and what's really looking not so good, is that double top, that decline, the break of support, the pullback, old support starting to work as resistance, and now moving lower again. We are seeing that the RRG lines are responding to that little hiccup in momentum. But if we bring that daily RRG, that daily tail back for XLY, you see that here. And if I'll just quickly switch this chart to a daily price chart, then you will see that is definitely lower, and that is pushing lower and lower and lower. So I think the danger is now coming from the discretionary sector that has held up a little bit. It was pretty good last week, a week before, but it's now really starting to roll over, and that could be a damaging factor for the market as a whole, and that could be the big driver with tech now consolidating, discretionary could be the next important sector to actually put downward pressure on the S&P 500. So please be aware of those sectors as potentially damaging for the market as a whole. On the positive side, I'd like to point you to the chart of energy. Long big tail is now inside the weakening quadrant, but as we talked about it in the overview, it's still the strongest, and it's confirmed by the daily RRG, so it's a strong sector. And what's really, really good and what I really like is the fact that we bounced off this resistance level and we're now pushing higher. I take that as a very positive sign, especially combining that with the relative strength line that broke its resistance line and is now testing that former resistance as support. You see that the RRG lines are rolling over a little bit. That's causing the rotation into the weakening quadrant. But with that bottoming process ongoing, I think that this will be able to turn back up. So the RS momentum to turn back up while RS ratio remains above 100, and then push further potentially towards the high 60s, so 67.5. That's the topish area that we've seen here. I like to use the last few minutes that are left to dive into a comment actually that was posted below last week's video. Title of the video is "It's Not Good Under the Hood." That was the May 11 video, and if you if you go into the comments and you scroll down, you will find a comment by SK Aaron, not sure how to pronounce that. Great show, Julius. I'm an option player, and how can we apply your extremely good analysis in winning options? Any thoughts? Stay safe and have a great week. All right, so extremely good analysis. Thank you very much. Just be aware that I am just human, flesh and blood, and I, do everything normal humans do. Nevertheless, I'll take it as a compliment. So thank you very much. There is no specific way to answer this. And the first thing that sprung to my mind when I read this comment is I have written an article about that a while ago, and I looked it up. It's an article that I wrote in the RRG blog actually on June 15, 2019. It's almost 2 years ago. The title is "Technical Market Analysis and Portfolio Construction Are Two Completely Different Animals in the Same Zoo." And what I mean by that, and I invite I'll post a link in the comments or in the description. I'll invite all of you to actually go in. It's a evergreen article. It's not timely. And what I try to explain there is how you need to marry analysis and portfolio construction, and they are really two different things. So your analysis is actually, making up your mind, what do you think of the market? And then portfolio construction involves everything it's basically translation. It's translating your view, your vision into an actual position. And whether you do that with cash equities, with ETFs, with options, doesn't really matter. It's just the whole thing of constructing your portfolio. I think I need to do a little bit more. I can expand a little bit more on that maybe in an article or a future show. But I thought this was a very interesting comment, and I wanted you to know that that article is out there for you to read. So go in there, read that article. And SK, I'll save this comment and I'll come back to it at a later stage, either in a blog or an article, because I do think it's a very crucial element of investing. We're done. Ladies and gentlemen, thank you for watching. This was Sector Spotlight. Sector Spotlight airs every Tuesday from 10:30 to 11 a.m. Eastern. Thanks again for watching, and I hope to see you again next week at a new episode of Sector Spotlight.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.